Good evening and welcome to this very special post budget discussion where we will dissect the details of the first full budget of the Modi 3.0 government and try to explore the long term themes or sectors that are likely to gain from the announcements made today. Finance Minister Nirmala Sitharaman presented her record seventh budget, where the focus was on employment generation, skilling, and improving the ease of doing business for MSME sector. The focus on infrastructure spending continues to meet their budget, and there was a special focus and many stops for states like Bihar and Andhra Pradesh. The fiscal deficit target for this year has been pruned to 4.9%, and standard deduction for individual taxpayers opting for the new regime has been increased to 75,000 from 50,000 rupees. Now, to help us piece the puzzles of the budget, I have with me market veterans who are expert stock pickers to help investors create long-term wealth. Please welcome our experts from HDFC Securities. Please welcome Mr. Deepak Jasani. He heads retail research team at HDFC Security, where he guides the team in equity and equity derivatives and fixed income. Deepak brings remarkable insights across multiple verticals in capital markets over his 2 decades of experience. We have with us Mr. Unmesh Sharma. He heads the institutional equities business at HDFC Securities. He was a top-rated research analyst in real estate, telecom, and consumer sectors, covering India and Asia-based clients in sales, and headed the equity capital market syndicate prior to HDFC Securities. We also have with us Devarsh Vakil. He is Deputy Head of Retail Research at HDFC Securities. He has over 20 years of experience in the field of financial market research. His role entails generating investment ideas and anticipating trading opportunities. Devarsh also closely tracks global markets and important international data points that impact Indian markets. Thank you all. Thank you, gentlemen, for joining us. It's a pleasure to have you with us.
Thank you for having us.
So I'm going to start by taking each one of you's reaction to the budget. Deepak, could you go first? How do you view the budget and any term adjective that you'd like to attach to this year's budget?
Yeah, so basically we are broadly positive with the outcome of the budget. Initially, with the announcement of the increase in the capital gains tax and STT rates, there was a negative reaction. The Nifty fell quite sharply. But as people appreciated the medium-term implications of the provisions or measures which have been announced, I think, and also the fiscal consolidation and the reduction in the debt, uh, I think a lot of dip buying happened, and markets have, I think, closed almost flat, which is very unusual for a budget day.
But all unusual things can be expected, on budget days. Unmesh, could you give your assessment of the budget? Because, we get lots of adjectives, forward-looking, pragmatic, all-inclusive. What's your objective for the budget?
I think about 90% of the budget was more of the same, which is good because what people like is stability. Of course, the tax change is the one that caught people by surprise. Having said that, if you really look at the commentary in the last few days from the chief economic advisor or the SEBI chair on the derivatives, the STT, I think was something which kind of we saw it coming. On the other tax, I think, longer term, the vision of the government has been that eventually all various investment avenues should have singular taxation. So from that perspective, this is a first step in that direction. So broadly, I think the reason why the market, went up and down and then finally flat is because I think the market's taken its in its stride, and probably in a couple of days, with the exception of some of these tax changes, will probably move on from here.
Like Devarsh, the markets have had a superb run over the last many months. Post budget, do you think it is now time to churn your sectors, look at something else, churn your portfolio, look at something else? Which are the sectors that you think will do well, and what is your broad-based take on the budget?
Right. So, as my colleagues pointed out, it is more of the same which we have been seeing. the valuation of some of the sectors in the capital goods side, on the PSU side are so atrocious that there we don't find some opportunities, and that's what we also see on the market reaction today. After the introduction of various taxes, we saw that the markets fell, and then back of the buying in most of the defensive sectors like IT, FMCG, and healthcare, it recovered. So we feel that the time right now it is not to be aggressive, but look at the opportunities in the defensive sectors, FMCG, healthcare, IT. I think that's where we need to park capital for now, and individual stocks and sector specific opportunities may emerge at the later point of time. So post this budget, it is advisable to be a little cautious of the markets.
All right. Deepak, the government came in and announced a fiscal deficit target of 4.9% for this financial year. In the interim budget, it was 5.1%. Now you have taxparency, you got rich dividends coming in from the RBI and PSUs, and yet the government is tightening its belt. What kind of signaling is this giving to the markets?
Yeah, so I think the 4.9% fiscal deficit is a signal which the government wants to give, that it wants to stick to the first fiscal consolidation path. Uh, People were not expecting such a sharp cut in the fiscal deficit. Most people were expecting 5 to 5.1%. It has come at 4.9, which is a pleasant surprise. Now, of course, the RBI bumper dividend gave the flexibility to the government to cut their fiscal deficit, but it also means that it did not go for some populist measures or populist outgoes, which is prudent for the government at this point of time. It has also said that for the next year, the fiscal deficit will be around 4.5%, and that going forward, the government debt to GDP ratio is slated to fall. So these are all sentences, or these are all words which will be music to the ears of foreigners, especially the rating agencies or the institutions or the investors. They will get excited by this. Uh, and these are not empty words. The government has in the past shown that it is capable of achieving what it sort of announces or what it projects. So, in that sense, I think it is a welcome announcement, and uh, it has implications on the domestic interest rates because of the lower debt which it has projected. And it could also, over the next few months, result in rating upgrades for India.
All right. So, in the eyes of global investors, India has always been a good market. They've given a premium to a somewhat risky market like ours because of the growth prospects. Now, Unmesh, given this macro scenario of the fact that the government is tightening its belt, perhaps signaling that it will borrow less. If you're borrowing less, there's less crowding out. If there's less crowding out, then interest rates should go down. So, should interest sensitive sectors be the ones people should start building positions in, or like Devarsh is saying, go for defenses?
Yeah, so look, I think very interesting point. If I add a nuance to what Deepak was saying, I think the most important thing is the fact that the math of the government is also very credible. If you see with the economic survey yesterday, the nominal GDP expected is 10.5%, and for most tax assumptions, they've not taken growth of more than 11. Now, in that context, what you're saying is right. And do note that also the capex budget for the year, given that we are already 4 months of election-related slowdown has gone past us, the entire capex number is also, infra spend is also very strong. So, in that context, what we expect is that the benefit that they got from the big, surplus that the RBI transferred to them through the dividend, and you put that in context with the math that is in front of us, it actually will crowd in the private sector. It helps bring the interest rates down. In any case, with global interest rates also on their way down, we can easily see 2 to 3 rate cuts through the rest of the fiscal year. which should bode very well for the markets and for interest rate sensitives as well. But generally, if you see our model portfolio, even uh, after the elections, was very focused on continuity of policy, which meant longer term themes like manufacturing and domestic infrastructure and economy facing sectors.
Right. Devarsh, would you also agree with the assessment of both speakers? Why I'm asking is because, if interest rates go down, people believe, people will buy more cars or bikes, people will start buying homes. But there are other, say, for consumption, there is nothing clear cut or straightforward incentive or disincentive in the budget. But the expectations are very high from people, especially the middle class, who has borne the brunt of inflation for so many years with little relief. Because on the tax side, with the exception of the new taxation regime, nothing new, nothing big has really come about. This year, there was an increase in the standard deduction only in the new scheme. Now, I'm trying to understand that, how should I invest in? Should I go for interest sensitives? Because there is this whole question mark about the real estate sector, given that regime change in capital gains. If capital gains for long-term assets without indexation in real estate, isn't it really negative for that kind of interest-sensitive sector?
So right, so you have mentioned a couple of points. So yes, government has given little bit of more income in the hands of consumer by increasing the standard deduction in the new taxation regime. So that would put some more money in the hands of consumers. And actually, government's aim was not to increase the taxation, but I felt that the need to rationalize the taxes and simplify was the main theme. We saw it across many asset classes. And as my colleagues pointed out, the tax buoyancy is clearly there. I think for the first time, we saw that the income tax collection, which was around 3.4% of GDP, was even higher than the corporate tax collection, which was around 3.2%. So we have good tax collection. That means the incomes are high, and government wants to encourage the spending. For employment, we saw a lot of new scheme. The first timer scheme where 1 month wage for all the person entering the workforce, government is going to give about 50,000 rupees in 3 installments via registered EPFO. There is a scheme where government is going to provide the contribution to employees for the first 4 years of employment. Up to 30 lakh youth is going to get benefited, and about I think 3,000 rupees for 2 years up to in EPFO. So all these
EPFO contributions.
yeah, are going to help increase the consumption. So at beyond short-term volatility, I think consumption and consumption-related stocks should pick up. The theme towards premiumization or aspiration from basic discretionary to conventional space to higher and higher consumption spaces are looking interesting to us.
Right. Devarsh, then what are you suggesting to the retail investors? You said that don't please run after the overvalued stocks and capital goods. Consider healthcare and IT. But there's nothing in the budget for healthcare and IT. I mean, IT isn't one that is affected also by the budget. Most of their services are exported, and globally there's still stress. We hear so many stories, no jobs, type of stuff, so on and so forth. So where does the money go? If consumption has run up and it's expensive, if capital goods has run up and is expensive, just by default, should you go for a cheaper looking stock, or where is their value now?
So there is, as you mentioned, there are opportunities where we find valuation little more attractive compared to the area. So as I pointed out, some of the PSU stocks, the capital goods stocks, where the margin of safety is not in our favor. Uh, the money is there. We feel that only about 1.5 lakh crore worth of liquidity is available with the mutual funds. They are waiting for correction to deploy that fund. Even global funds and foreigners are also looking to invest into India. And I think opportunities in the FMCG space, defensive like FMCG, pharma, IT. That's where investors can look at now. And over the medium term, as the US election results come out and as the uh, lower interest rate cycle kicks in, I think the interest rate sensitives also should be looked at. We are around 24,400, 500 kind of Nifty level. So if I look at the consensus earnings of about 1150, we are about 21, 22 times next year forward earnings. So these levels are not very conducive. It's not very attractive that investors should be very aggressive in higher beta sectors. It is better to pay a little defensive right now.
Unmesh, what is your suggestion? See, institutions are very smart. They will hold on to cash and wait for the right moment to enter in. And do you know when is the right moment? And when the right moment comes, whenever it does, what is the area where the institutions would like to walk in and start picking up stocks?
Yeah. So look, I think we've 21 years of my career has taught me that one does not try to time the market. The what okay, I'm on the same page as Devarsh. Okay, so what the valuations are not giving us comfort at this point in time. If you look at FY25 earnings, because because of this budget earnings, beyond the really the gold sector is not really going to change much. So if you look at you assume a stable earnings system, we are actually more than two standard deviations above on an FY25 basis. On FY26 with 12% growth, the market is still over 20 times. Now, in this type of scenario, if you enter the market today, then does that mean that you are going to make outsized returns in the short to medium term? The answer is that the odds are against you for that to happen. Having said that, the way what is happening, however, is that there is a very big theme which is happening in India currently, which is the financialization of and the participation in the market, and that is something which is very akin to what happened in Hong Kong, China in 2003 to 2008. So there's a flood of liquidity happening, and one of the reasons why there is a buy the dip type of mentality in there is because people genuinely believe in the long-term prospects of India, which are actually reinforced if you think about it from this budget as well. So how do you play this? One is that we never advise any institution to be more than 5% cash. That is how our model portfolio is as well. Having said that, I genuinely believe that what Devarsh is saying is right, that there has to be some amount of caution. And which is why there are two ways to do this. One is that in the interim, you can play some of the stocks where there are secular drivers and interests are aligned with the government. For example, the low end of the consumption. After the government having formed a coalition government, and you can see that some of those have started to play out in this budget itself, where support at the bottom for the consumption is showing up. So you would want to reduce your underweights or at least go overweight on some of the FMCG as well as the rural themes like Maruti, for example, which is or the two-wheelers, which is where we have some weight in our model portfolio. And at the other extreme is basically you see through the cycle and figure out what are the longer term views. Now, there is one very interesting one, which again, Devash was talking about on the EPFO. What is the point here, right? The point is that there is a huge push towards making the economy more formalized and more, more formal and more organized. So, if you look at these themes, what you will realize is that financialization of savings through the insurance route, for example, more formalization, including in fuels, for example. So you could have gas companies in there, and in the interim, you are trying to play things which don't get affected. See, you rightly said that there was nothing for IT or pharma in the budget. That's a good thing, right? Because that much lower volatility. So in that sense, going slightly overweight on IT and pharma again becomes a very good idea. So that's how we would look at the portfolio.
All right, and I'm understanding the logic of how to go about, churning your portfolio. Deepak, post the budget speech, are there any hidden or not sought for sectors that one can consider now if the government is proposing to come up with SOPs, say in nuclear energy, in smaller nuclear plants, or in stored hydro pump power? They're saying look at hydro pump power as storage, energy storage, and not electricity. Are there any plays here? And how does one work on this whole theme of the kind of incentives being given to MSMEs. You're getting credit guarantees. You're getting help towards digitization. But these smaller companies are not listed, or they're listed on separate platforms. How do you play these themes?
Yeah, so one will have to appreciate that a lot of the announcements that is made in the budget is to sort of cater to various lobbies or various industries. So one will have to look at what is the amount of allocation is that is being made to the particular industries. In So this nuclear power, very small allocation is being made. So in that, and there are no direct plays for that in the listed space except a few MNC capital goods companies. But having said that, I think consumption theme will get a push because of the rural and agri spend, and also because of the extra money, about 17,500 rupees, which the FM mentioned in the urban population's hand. So those two things will help the boost the consumption, mainly staples and a little bit even in discretionary. Apart from that, there are specific provisions for aquaculture where there are not too many listed companies, leather, textile. Uh, a big announcement is about this employment linked incentive scheme. Now, there, I think there are a few companies who are engaged in manpower's sourcing.
Management, manpower
So
sourcing.
those companies may benefit out of this because there is a big allocation for the next 6 years. So the visibility for those companies will improve dramatically. Uh, and as far as MSMEs you mentioned, I think MSMEs mainly are the suppliers to capital goods companies or to the chemical companies, mainly to these two sectors in the economy. So if you encourage MSMEs, you are indirectly encouraging those two sectors and the various other sectors that MSMEs cater to. So there is an indirect benefit to these industries also.
Right. Umesh, you were talking about greater financialization of our economy, and that leading to pull for financial products, and those are the sectors to watch out for. But as a layman, I get so many mixed messages. Um, Long-term capital gains is increased. Then there's STT. STT was brought in so that we could phase out LTCG, but LTCG is still there and higher. If you really want me to buy financial products, why don't you give me clear cut incentives? Yes, there is an incentive for health insurance, but there is no separate incentive for life insurance. It's clubbed into ETC. I can buy ELSS instead of life insurance. So, I mean, how do you really get those targeted benefits of financialization without these kind of incentives?
Yeah, now look, this is the trillion dollar question. I think this is something. Okay, so the first thing is that this is something that governments struggle with globally. I remember that we used to think that the United States has a very simple tax regime, and I worked there for a year. I can tell you that it's quite complex, very similar to here. What has happened is that even in this case, if you look at the specific example on insurance, is that in the short term, the government makes certain moves to incentivize something, and then it becomes a longer term issue. But in the budget speech, there was one very interesting point made by by the finance minister, that they are looking at what would, let's call it, akin to the direct tax code, where they want to actually look at the entire tax regime together. And I think that should be able to solve a lot of the issues that you're talking about. But broadly, I don't think that. I think while there are mixed signals, yes, but there is one very common theme which runs across all of this, and the common theme is that at the end of the day, the government wants to widen the tax net, which means that they don't want to leave any loopholes open for you to invest. And the example being buyback versus dividend. And similarly, if you look at the longer term, what they want to do is that they want to take away the tax, confusion. For example, whatever we may say about what happened in real estate, The fact of the matter is that it is now a simpler version as compared to what it was a day ago. And similarly, what they're trying to do is that whether it's debt or equity or real
Or
estate or for that,
gold,
even other
even
things,
gold, right? Fixed
yeah,
assets.
even good. It'll just become standardized. You know that wherever you go, this is how much tax you're going to. So now, in the interim, what may happen is that there is a lot of confusion as to what happens now. But what we seem to be converging to is basically two tax slabs, long term and short term, in which long term and short term, the period will also be defined in advance. The only thing that I was noticing was, and I was wondering whether this is the end, because this cannot be, because the fact that you move from 10 to 12 and a half, it doesn't feel like a round number. So what
Yeah,
may
so
happen
it's going to
is
go
that
higher, right? That is
I
what's
think,
going to happen, right?
or it may be 12 or 18. I don't know what happens. That is something for the finance minister to determine, because they'll also have to look at tax neutrality in the short term. They don't want to take a tax hit either. So what may happen is that they may have a glide path maybe or 2 years from now. And she did mention that 6 months from now you will hear from us on this. So let's wait and watch as to what happens. But I think that we are moving towards clarity rather than away from clarity in this.
But
And
Deepak, yeah, Deepak, please go ahead.
And to add to what Unmesh has said, I think under the new tax regime, there are no deductions available for your LIC premium or for mediclaim.
Yeah.
So government does not want you to sort of invest or
To save
uh,
tax.
invest to save tax. They want to do it independently. So it should be for your own benefit and not just to save tax.
Yeah,
That
your
is the
benefit should, you should calculate your benefits post LTCG now because that is becoming very clear cut, right? So, Deepak,
yeah.
I'm still trying to understand what is the messaging of the government. Is the messaging of the government ki, don't earn too much? If you earn too much, you have to pay a lot of taxes. We want all of you to have a roof over your head, but if you sell it, get set to spend a lot in taxes because the indexation benefit was a big one in real estate. You buy property and you hold it for years and years together, right? And sometimes the property value is 10 times of what you purchased it at. Now the tax outgo would be significant. So what is the government trying to say? Earn and spend or invest at your own risk? What is the messaging for people who, the salary class who goes and earns? Better to spend or better to save?
Yeah, so I think government cannot dictate as to what you should be doing. Government can only sort of lay out
Signal.
signals. Now, here uh, you mentioned about the real estate gains now not getting indexation benefits, but at the same time, the LTCG rate has come down from 20 to 12.5%, so which is a very big concession to the real estate owners. So in that sense, government has been fair. On the one hand, they have taken out the indexation benefit. On the other hand, they are reducing the tax rate. So effectively, your net outgo will be much lower. So let us give credit to government where it is due.
All right. We'll have a lot of experts coming in with a calculation soon enough. Devansh, want to ask you, the government is ticking off many of those check boxes, lower borrowing in the future. We want you, foreign investors, start looking at investing in India in rupees. Uh, Fiscal control coming in. So a lot of check marks coming through, and of course, the focus on growth. So, how does India now appear to foreign investors vis-a-vis other economies? And why I ask is this: there are many things that work in our favor that I have marked out for you. But one thing that makes India stand out as opposed to China is that it's a democracy. It is a thriving democracy. Now you have to also, give something for the social development of the economy. That is where it will thrive. That is when this economy, democracy will thrive. We are not really seeing a lot of spending by way of welfare or even development of say colleges or hospitals. So in the light of what has come out in this budget, how does India appear as a market to foreign investors?
So India do appear very attractive. So a lot of points you laid out. First is about the attractiveness to the foreign investors. I think Indian government securities have been added to the global bond indices. The fiscal deficit which government has controlled has led to increase in probability that few quarters down the line we will get sovereign upgrade, and that will also attract a lot of foreign capital into our debt side. The interest rate across the globe are headed lower, and India will also be a beneficiary. Second thing which you pointed out, government has given signals. See, they don't want to just increase the taxes. The idea is to increase the compliance, make it more rational and clear, so that more and more people come into the tax net, and that's what they are trying to rationalize across various asset classes and help generate more revenue. Government has given a lot of incentives for the employment. On agricultural side, they have given a lot of new programs, allocated around 1.5 lakh crore to education. So all these things will help increase the allocation at the bottom of the pyramid, and that will help a lot of people move out of the poverty line. So I think government has done a good job in trying to increase the allocation towards the important social sectors, education, health, agriculture. At the same time, they have also given higher allocations to defense, railways, and other government expenditure areas, so that the economy also grows well. So, all in all, I think it's a good document, policy document, where they have tried to balance both. And as I've been seeing for last 20 years, after every budget, I think you cannot satisfy all the quarters. So I think they have done a reasonable job of trying to balance the things.
You can't make everyone happy all of the times, right? So we're going to come to the close of this discussion. I'm going to take some concluding remarks. I'll start with you, Unmesh. The budget's done. The announcements are made. What's next? What are you looking out for, and how would you rate this budget?
Yeah. So if I may, before I give my concluding, I want to just add to something that Devarsh was saying, quite interesting. See, from an FPI's perspective, because we do service the institutions, one thing that I can tell you is that the increase in tax does impact at the very margin in the short term the expected returns for the market, right? So it's not like there is no impact, but at the same point in time, there is one very important thing. If you look at whatever the government's done in the last few years, for example, even on the debt market side, and now if you look at a stable tax regime with good fiscal consolidation and excellent balance sheets, both at the sovereign as well as the corporate sector, we do have to acknowledge that structurally, India is becoming a much more attractive place to invest. So in the short term, this little bit of hit that you get from expected returns, is that enough in the long term to offset? We believe the answer is yes. So it does, I'm on the same page with a slightly different reasoning. To come to your other thing, if you look at the budget, I genuinely believe that a vast majority of the budget, I believe, is exactly in line with what we thought earlier, because it's a continuation of the first two regimes under Prime Minister Modi, where we are talking about the domestic sector, we're talking about infrastructure, we are talking about reducing dependence on subsidies. All of those themes remain intact. At the same point in time, a lot of focus is going into things like skill building, for example. Also, there are things which I believe are also things which have been learned from the election. So if you see the preamble of the speech itself was talking about poor, agri, women, and youth. So, I think what is going to happen is that in the next 5 years, we are going to see I feel that maybe the impression in the markets was that there was a little bit too much focus on asset creation, a little bit less on the support for consumption at the bottom end. I think that changes. And with the exception of the LTCG, and even now there are questions being asked about whether something gets grandfathered or not. I think that may take one more day to evolve, but I think the financialization of savings, that theme will continue, which means that it should be business as usual maybe 2 days from now. And while valuations are expensive, we still believe that this is a great market to be invested in, and incremental money should be deployed here.
Perhaps the government has bought into the idea that instead of giving a man fish, teach him how to fish,
Absolutely.
And that is something that is going to work in our favor in the long term. Devarsh, your concluding remarks, and if you could please also give us your opinion on the expected performance of the rupee from here on. It has continued to weaken quite a bit. Everything is going right, we got inflows, we got great growth, but the rupee is not one which is stabilizing, continues to look weak. It is because of the Fed, and now that the budget is done, is the Fed decision next? how would you sum up the budget and what to watch out next for?
So as Unmesh pointed out, couple of years down the line, it will be business as usual. Most of the provisions will be done and dusted within couple of days. The sectoral rotation will play in. For the rupee, the issue is that we also compete with the China in the global market, and as we have seen that they have depreciated that currency, and they are trying to anticipate more uh, tariff barriers as the President Trump is likely to win now. So as a country, we are doing a right job by not allowing our currency to appreciate and keeping it a little weak so that our exports also play out. Apart from the um, usual exports, now India is a large services exports. The global capability centers are coming up, and we need currency support for that sector as well. So I think the volatility is actually very less in the currency market, and it is likely to fluctuate between this 83 to 85 for time to come. I don't think much volatility will come in there. RBI is doing a fantastic job of keeping that currency stable.
Right, Deepak, I'll come to you for your concluding remarks and assessment of the budget today and what you're looking forward to next.
Yeah, so now the markets post the next 2 days will come back to the usual analyzing the triggers and concerns on a day-to-day basis. Uh, how, how the monsoon progresses from here, I think, is the key in the near term. Whether it covers the whole country, the spread and intensity of the monsoon is what people will like to track and analyze, because that will have a repercussion on the agri output, on inflation, on rural incomes, on consumption, etc., etc. Plus, the balance Q1 corporate results are will be watched for very closely and deciphered. Global interest rate trends will also be looked into. How soon will be the first rate cut from the US and then from India? That is something people will want to look forward to. And finally, the US presidential election and its impact on India. Of course, there may not be a very big impact on India, but uh, people will like to sort of believe that who becomes president in US will have an impact on the Indo-US relations and the trade and India's competency, India's flexibility as a growing superpower. So those three or four things is what the markets will like to look forward to and analyze once the budget analysis is done and dusted and out of the way. We remain cautiously optimistic on the markets because of the flows and absence of large negative triggers. Even today's trigger was negative only for a few period, a few hours, I suppose. Rest we recovered quite well. So unless we have two or three large negatives coming together, markets are not willing to fall sharply.
All right, so you would suggest to investors to remain invested and not worry about the short term because it's more of the same that continues, and that should be the same for our markets as well, right?
Yeah, so at the same time, one should keep doing asset allocation review. If you are overexposed to equities, it is a good time to take some profits out, have some cash on the side to invest when the markets ultimately fall, and also do a sort of stock review, sector review, etc., etc. So that is an ongoing thing that you cannot not do.
All right. Thank you so much for joining us, Devar, Shunmesh, Deepak. Thank you so much for joining us and
Okay.
analyzing the budget for all viewers. Do keep a track of HDFC Sky website. This is where you get all the updates on the markets, how you should realign your portfolio, and the analysis of the budget as well. We've done the analysis now. Our experts telling us that this is a budget for the longer term, and it continues with the theme that the government is stuck to. which has been creation of infrastructure and growth opportunities along with employment. So this is a budget that gets a thumbs up in the long term, and also gets a thumbs up for greater clarity and transparency when it comes to taxation. Thank you all for joining us, and do keep a watch of the HDFC Sky website. Bye bye.
Thank you for having us.
Thank you. Bye
Thank
bye.
you. Thanks.
Bye.